Welcome back. Asian markets are quiet today. They're not selling off on the back of the US market move down last night, but they're all quite subdued. And the SGX Nifty also has been trading in a very narrow band, now down about 6 or 7 points. So it looks like we'll start off flat after the pullback to 5,300 plus yesterday. Tirthankar Patnaik of Religare has joined in now. Good morning, Tirthankar. What's your sense now? Would you continue to trade the market with a cautious stance going forward?
Yeah, morning Udayan. We maintain caution on the market. Our call through the year has been that while Indian markets could see some risk on basically filtering in from the global side, the macro fundamentals don't look anything but bleak. And basically since August, our stance has been actually just vindicated. Numbers look quite bad. Today the GDP number is expected at about 5.1%. We are marginally lower than consensus, which is at around 5.3. This essentially takes our FY13 number quite low from we had 6.7 earlier to only about 5.5, 5.4 levels. So until the macro fundamentals look better, there's little to push the market beyond just perceptions of liquidity infusion. In that aspect, the speech at Jackson Hole by Ben Bernanke this evening will also have some information, but our understanding is that there's unlikely to be anything incrementally positive for the market from that end. So we maintain caution in that sense. So maintain sort of our defensive stance for the markets. From a valuation perspective, again, the market is trading at around 13 times, which is where we believe the market should be trading at, roughly a 20% discount to the long-term average. And we don't see a lot of upsides in the market at this point.
Which are the sectors where you would start to get extra cautious on in terms of taking profits off or even avoiding downright?
Clearly banks. Asset quality is likely to be the big sufferer. We have seen that panning out through the last couple of quarters. But now as growth really takes a dive, so we are going to see asset quality concerns actually exacerbate. Now here, the January to March numbers were around 5.3%. Follow that up with an April to June number of about 5.1% or 5.3%, whatever the consensus number is. And the second quarter number again, which is essentially the the September quarter number, we are expecting it to be only around 5.1, 5.2% again. So which means that asset quality is likely to continue deteriorating. Now PSU banks have sort of paid the price at this point. Most of them are trading at well below book and have underperformed the broad market quite substantially. We believe private banks are one place where we should be getting cautious at this point, because they have not really seen the pain at this point until now. So I would be, if you ask me what sector would I be really cautious on, I think private banks as a pack is one thing that we should be really getting worried about at this point.
Tirthankar, hi, good morning. Thanks for joining in. You spoke about no great upside to this market, but what about the downside? Do you think this market could extend itself to that 16,000 level that we saw in the month of May, or is the downside looking even more bleak from here?
See, downside, the market has been trading at these levels for quite some time. It has flattered to deceive with the 3-month intervals over the last 3 years now. So even this year, we've had a classic rally in the beginning part of the year with LTRO2 coming in, LTRO1, LTRO2 coming in, and then we saw the markets actually took a breather when budget and GAR, those issues came in. By June, we had pervasive negative sentiment, and then we had the market bounce up. Hopes of a change at the finance ministry, and that leading to reforms were building up, and then there were hopes building up on the global macro as well, that we were expecting more liquidity to come in. So market has not really gone anywhere in terms of actual movement up. So in terms of downside, I think given the macro fundamentals, we might see marginal downside. The market is actually pricing in my opinion, about 6% growth for this year. If it comes in actually 6%, I'm saying FY13 numbers, if it comes in substantially less than 6%, we have some downside at this point. But from a fair valuation perspective in the near term, I think the market should trade at around 13 odd times. So we are where we are in this point. We don't think the market has a lot of upside at this point. Downside, that comes when the GDP numbers come down. One more thing we should not forget, Sonia, is a sovereign debt downgrade is looming upon us. I think the probability of an S&P downgrade actually rises once the GDP numbers come out today, and if they are fairly low numbers, then we should almost take it as given that we'll see a sovereign downgrade. That might put additional pressure on India.
In an environment of extremely slow growth and high inflation, Tirthankar, how would you approach sectors like capital goods or infrastructure? How many more quarters of pain do you expect to see on the earnings front before they trough out?
Look, like I was saying, I mean, first quarter numbers are coming out today. Second quarter numbers are again expected to be weak. We might see some upside in the third and fourth quarters, largely coming out of a base effect. I'm not expecting anything much to happen on the government side. On the whole, from a 12-month perspective, I'm expecting rates to come down. I know the RBI has been, maintaining their stance of, preference for targeting inflation, working on inflation rather than growth, and they're saying that it's okay to sacrifice growth in the near term. However, we believe that if growth numbers continue to disappoint like this, then the pressure on RBI might be overbearing. And so from a 12-month perspective, we see rates coming down. And again, from a 12-month perspective, perhaps we see some closure on the government side also. So that's where probably, you might want to look at capital goods. So my point is, don't look at capital goods and infra at this, right now in the near term or the mid term. So just stay clear from this point.
So if you had to have some money in the stock market right now, where would you hide? I mean, if you're not very bullish on banks or infrastructure, which are the key legs, would you still bark up the FMCG pharma tree or IT? What's your portfolio going to look like?
Okay, so yeah, I know banks, especially private banks, has been, the one place where we are saying, more pains could come in, because what has happened in the last 2-3 months is people's expectation on the economic slowdown and basically expectations of a revival have actually been beaten down. People are not expecting numbers. The market is not expecting FY13 numbers to look good. Even FY14, many, some of the clients I spoke to say that half of FY14 might just get washed out. We might have an election. So a lot of things, too many variables there for the economy to actually, boost up at this point. And, asset quality is just a function there. So clearly that's a big sector where we are unlikely to see much change. So that leaves very, a selective show on the portfolio. We are still partial cement, stocks like Ultratech, Shree Cement. I would rather not go into detail on the stocks, but stocks like Ultratech, Shree, we like Reliance Industries at this point. From again valuation perspective, we believe things are largely priced in at this point. Again, FMCG, while HUL, ITC have been near their peaks 24, 28 times, we like stocks like Imami, Dabur, and so those are the stocks we'll continue to hide in at this point actually.
I just wanted to ask you about one bank in particular, Tirthankar, IndusInd, where you guys have a buy. That bank has a big exposure to the commercial vehicle sector, and we've seen so much turmoil in that space. Would you not be worried about that?
So we have I think for IndusInd Bank, growth, which is the key at this point, is likely to continue surprising on the upside. We know that CV cycle is likely to see pain, but Ashok Leyland's numbers have been fairly okay at this point. So it's still a mixed story on CV cycles. IRP numbers, which are normally perceived as a lead indicator for the CV cycle, have not been have been actually quite negative, have been quite bad. But we expect IRP to actually pick up by the second half of the year. So for IndusInd, I think we will still wait and watch. And it's basically, if you ask me from a if you put a gun to my head, from a private bank's perspective, from a portfolio perspective, I will probably not look at IndusInd Bank. But if you want to rotate in the banking sector, IndusInd is one place where we'll definitely like to be in. So it's basically different mandates, different choices. So from that end, IndusInd is something which we like. We also like Yes Bank in that space. We like housing finance companies. If you want to shift into the financial space, we like SDFC from that perspective. It's essentially how you want to look at it actually.
Okay, we'll take a break on that note. Many more stocks to chat about. 15 minutes before the pre-market bell rings, so we'll come back.